All right, so let's begin the live question answer session. And to answer all of your queries today, I have with me Gautam Kalia, Senior Vice President and Head Super Investor at Sharekhan by BNP Paribas. Gautam, good evening and welcome to the show. And let's take up our first viewer question, which is from Rekha. She says that she's a senior citizen and a long term investor. She wants to create a long term portfolio for her granddaughter, who's right now 8 years old. And she wants you to advise her to invest in equity via ETFs. And she also wants you to recommend two equity ETFs for direct investment. So, Rekha, we don't have you on the phone line. We have no idea as to how well versed you are with the equity market. But then it's a great idea to start investing for your granddaughter's a better future. And a very important learning for her also, growing up ahead. But then, Gautam, since I'm assuming it's a very long time horizon for her, and it's just wealth creation and accumulation for the better future of her granddaughter. I want to understand the route that she suggests or want to suggest via ETF is the one that you might want to recommend, or she can also have that as one of the options in the portfolio, and it could also have a different active route in the portfolio for her goals.
Yes, so for Rekha, I would suggest something which is a combination of ETFs and actively managed mutual funds. The reason being because maybe ETF is something that she thinks is appropriate because it's low cost and easily traded. But there are a lot of ETFs in the market right now that are not extremely liquid. So there are many other factors that need to be considered as far as tracking error expense ratio are concerned. So what I would suggest is that she look at one of the large cap ETFs which are extremely liquid, where you know you're getting something that is tracking the market very closely. So a Nippon India ETF Nifty 50Bs is something that she can look at, which is purely a large cap allocation, large cap play. Now, in order to build a more diversified portfolio and a well-rounded portfolio, which can be held for a longer term, because obviously she's looking to invest for her granddaughter who's 8 years old, I would suggest that she supplement that with some actively managed equity mutual funds as well. So because she's already got this large cap ETF, in her portfolio now, with maybe let's say 30% allocation, then she can look to add Kotak Equity Opportunities Fund, which is a large and mid space, which operates in the large and mid cap space with about 15% allocation there, and HDFC FlexiCap Fund with about 30% allocation, and Mere Asset Mid Cap Fund and HSBC Small Cap Fund. So the mid and small cap take over the rest of the allocation of about 25%. So this combined with the Nifty 50 ETF will make a well-rounded portfolio for her.
All right, so funds recommended for Rekha, Nippon India ETF, Nifty 50 Bs, Kotak Equity Opportunities, HDFC Flexi Cap. I just want to understand, Gautam, in the category mid cap and small cap specific, any specific reason why you picked up Mira Asset Mid Cap and HSBC Small Cap? There are better performing funds also in this category. So, what could be the rationale behind picking up these funds?
Yeah, so our research doesn't look purely at past performance. We look at risk-adjusted returns as well, and we look at a number of qualitative features. So it's a combination of quantitative and qualitative features. Most investors, when they select a fund, they just look at past performance and they select the best performing fund. That doesn't hold true in terms of going forward. It's like driving, looking at the rearview mirror. So you have to look at how much risk the fund is taking, because I can take additional risk and deliver higher return. So we want to make sure that we give funds that have a strong investment process, that have a very strong risk budgeting process, and basis that risk, they are able to deliver superior returns. These funds may typically not be in the top three or top five funds consistently, but they tend to be in the top quartile, and that's what our aim is when selecting funds.
All right, let's quickly move on to our other viewers' question, and this is from Nisha. And Nisha wants to know best mutual funds for building a corpus for higher education. Thank you so much, Nisha, for sending us your question, but we don't have all the details. We just have a goal, and we don't have the time horizon or the investment amount that you might want to put in for this particular goal. But if it's you wanting to create your own higher education corpus, congratulations, a great step. But in any case, what's the basic thumb rule, when you have these kind of important goal? Because it's not only Nisha, there could be a lot of other parents also wanting to, have a strategy for their kids' higher education. What's the right time when you start thinking for these kind of financial goals? And Gautam, we've talked about it a lot of times on several shows. We cannot forget the education inflation, which is obviously much more higher than food inflation and any other type of inflation you're talking about. You also, if it's higher education going abroad, you need to factor the currency fluctuation also. Basic thumb rule, what would be, when you want to consider these kind of goals?
Kavita, the easiest answer to your really tough question is the earlier you start, the better. And if you can start today, then please start today. Obviously, you can't start yesterday. And this question is really top of my mind as well, because I'm also thinking about future education planning for my son. Besides, obviously, talking to so many clients about education, and like you rightly pointed out, education inflation, whether it's in India or abroad, has been consistently in double digits. And that is really something that we need to watch out for. And particularly if you're thinking of sending your child abroad, then currency depreciation, because rupee historically has depreciated against the dollar at about 3% a year. So that also, adds to the inflation of education. So definitely the earlier you start, the better. Don't wait for it. I would suggest that you start even before you have a child. You don't need to wait, because that is some allocation that you'll probably have to make later in the future as well. Now we come to Nisha specifically. I would say I'll give her a ready-made portfolio. I don't really know for how long can she invest, but I'll give her a portfolio to start off with, a well balanced portfolio, but it will be completely in equity, assuming that she's comfortable taking a 100% portfolio in equity. So ICICI Prudential Blue Chip Fund, which is a large cap fund with about 35% allocation there. Bandhan Core Equity Fund, which is a large and mid with 15% allocation. Mere Asset Mid Cap Fund and HSBC Small Cap Fund, again mid and small with about 20% allocation. And HDFC Flexi Cap Fund with 30% allocation. That's in the Flexi Cap space. So this becomes a portfolio for her to begin with.
Although we don't have all the details, as far as the planning is concerned for this particular goal, but then Nisha, we hope that this all comes handy for you. And in case you want to send across a detailed portfolio or a detailed strategy that you have in mind, you can send this question again, and we will take it up again on the show. Anyways, let's move on, Gautam, and let's take Pradeep's question. He says that he has 45.32% of his overall portfolio in Parag Parikh Flexi Cap. He's got somewhere around 23.4% in Quant Active, 7% in Axis Small Cap, 10% in Canara Robeco Small Cap, and 7% in Mid Asset Large and Mid Cap. 5% odd in ICICI Pru Technology Fund. I really like the fact that he knows how much percent in what kind of fund the allocation is gone, the exposure is gone. So he wants your help in adding a mid cap and a multi cap, mid cap or a multi cap for SIP. And the holding time would be 7+ years. And he says he's good with volatility and been investing for 15 years now. And he also has a portfolio worth 75 lakhs, so which he will hold again for 7+ years. Currently 45,000 SIP going on in the funds that I just mentioned, and a few more with the weightage as well. He's mentioned all of that again in this question. So Gautam, I think you also have the question now. Okay, so let's begin with this one thing that he's asked. Adding a mid cap or a multi cap. Can a multi cap be a substitute for a mid cap and a mid cap for a multi cap? Can a strategy or understanding over here is right for the investor?
No, not really. Mid cap and multi cap serve different purposes. They operate in different parts of the market. A multi cap will have about one third exposure to the mid cap space. So that is why it's and a mid cap will at the very least have 65% exposure. So that's why it's important to know the difference. And I think he's the investor with the way the question is framed. I think the question is more about reducing exposure to one fund because of that fund has delivered well over time. Obviously, the allocation through SIP has also been fairly large. So what I would say is that Parag Parikh Flexi Cap Fund, where he's accumulated around
Parag
34
Parikh
lakh.
Flexi Cap. Right, right. Yeah. It's basically the exposure and the weightage that he's concerned about. 45% almost in Parag Parikh Flexi Cap.
So he's already got about 34 lakhs exposure there out of 75, and that is his concern. So what I would suggest, and when we look at his portfolio, while he's not asking for it, again, we have no option but to stay the course as far as our advice is concerned, and tell clients that you need to increase exposure to the large cap space. So there is very limited exposure to the large cap space, and that's why he's only got Mire Asset large and mid, but otherwise there's no other exposure, and that's why we want to bring in additional exposure there. So while we do answer this question, one is we add to ICICI Prudential Blue Chip, so we introduce that fund here. Redeem about 14 lakhs from Parag Parikh Flexi Cap and move that to ICICI Prudential Blue Chip. So Flexi Cap also has large cap, but then you have a dedicated large cap fund that way, which increases the overall allocation in the portfolio to large cap. And the monthly SIP of 34,000, which is again fairly high, to reduce that and move about 16,000 of that to a mid cap scheme, the Mire Asset Mid Cap Fund, as well as 4,000 to the sectoral fund that he already has, which is ICICI Prudential Technology. So that there is a very small allocation there. So we want to make it a meaningful allocation to that thematic fund. So increase that by about 4,000 per month instead. Also, the Quant Active fund, which is a multi-cap fund, there again the allocation is quite high. It's about 17.5 lakhs in the portfolio. So we want to move 7.5 lakhs from there to ICICI Prudential Blue Chip and reduce the SIP of 45,000 to about 20 and move 27,000 from that to ICICI Prudential Blue Chip. So essentially build a more large cap bias portfolio from its current portfolio, which is extremely mid and small cap heavy.
So go heavy on large caps, looking at the kind of allocation and weightage you have in your portfolio, Pradeep. That's the advice coming for you from Gautam. Let's take a quick break on this note, and post that also we'll be having our viewer queries on the show today. But I'm also going to flash our WhatsApp number and email ID just in case you're watching the show live. You might as well, if you want to ask, you can send across your questions on 8657974571. The email ID is themoneyshow@etnow.tv. See you after this break. Welcome back. You're watching The Money Show, and today on the show we are focusing on our viewer questions, and to answer all of the queries I have with me Gautam Kalia. Gautam, welcome back, and let's move on to our next viewer's question, and this is from Ramesh. It's via email. He says that he's 75 years old and open to high risk investments. He's investing 75,000 every month in 15 different funds via SIP, and he has distributed it across flexi cap, sectoral investments, active funds, mid cap and active mid caps and small cap categories, and in each category he has selected more than one fund house to benefit from the prudence of different fund managers, and he is not finding it difficult to track all of these investments as well. So he wants to know if his strategy at this stage and the kind of strategy he has of being so diversified across all market caps, is it right? We don't have him on the phone line because I'm sure we would have needed more clarity looking at the time frame, and he looks like a very high risk investor though, but what is this portfolio aligned with in terms of goals? A little more clarity would have really helped us, but just in case we don't have him, we are trying to get him online, but then so far whatever details we have, how does this strategy, it sounds to you?
Yeah, so the strategy seems fine, but the more I think about Ramesh, the fact that he's 75 years old, we need to be a little bit more careful and know more information. So, for example, how much asset allocation, how much money is in equity, how much is in debt, does he have a backup, is there medical insurance in place, what are his needs now, as in is he being able to generate enough income, is this an income generating portfolio that he's trying to, or is it just a portfolio that he's building for his legacy, for his next of kin. So those questions appear in the mind the more you think about it. And really, one question that needs to be asked is, what happens if the market corrects by 20% and the portfolio goes down by 20%? Does that have a direct impact on his life because he's relying on this portfolio or not? And that is really something that we don't have. But otherwise, in terms of strategy, he's saying that he's comfortable tracking. He's got 15 different SIPs. Is that the dates are different or schemes are different? If the schemes are different, maybe it's a little bit too much. But if he's comfortable tracking it, then I would say, okay, maybe try to reduce it to 10, 12 if possible. And otherwise, if you see the categories mentioned, again, I don't see any large cap there. So I would tell Ramesh to increase exposure to large cap, because he's mentioned the categories and he's not included large cap in that category.
All right, let's move on and let's take Nagesh's question. He's looking to invest in mutual funds to plan an SWP for himself for a fixed income. And he wants you to suggest good funds to generate 50 to 80,000 per month. Again, we don't have him on the phone line, so we really have no idea what's the corpus that's already invested, out of which he wants to have an SWP. But then for all those investors who are not aware of what exactly is a systematic withdrawal plan, Gautam, I think let's begin with this basic understanding of how and when should you be implementing a systematic withdrawal plan.
So, thanks for that question, Kavita, because it's extremely important. We talk to a lot of clients who look to have income generating portfolios, and that's really what a systematic withdrawal plan helps you, is define an amount that you want to redeem every month from your portfolio and across various schemes, and that in a way becomes your salary, your income, which is coming every month. And this is coming regardless of market performance. It is not dependent on the dividends announced by the scheme or the growth or let's say correction in the market. Obviously, one has to keep in mind that when market corrects too much and you continue to withdraw that, then it impacts your compounding over the long term. But when the market is doing well and your portfolio is growing, then you can even get away by withdrawing more. But the advantage of SWP is that you are able to define it as a consistent monthly income or salary. Coming to Nagesh's question, he's looking at anywhere between 50 to 80,000 a month. So the corpus invested can be anywhere between 85 lakhs to about 1.3, 1.4 crores. And he can set up a SWP, which is equivalent to about 7% of the invested amount. You get that money on a monthly basis. So you calculate, let's say you invest 1 crore and you calculate 7% of 1 crore, that is 7 lakhs. And that you divide by 12, and that becomes your systematic withdrawal plan every month. What I would suggest, I'm assuming that he's retired and he's looking for an income generating portfolio. I don't have his age, so we'll suggest a combination of equity and debt. So hybrid mutual funds are the best way to go here. Dynamic asset allocation schemes like Edelweiss Balance Advantage Fund, HDFC Balance Advantage Fund, and ICICI Prudential Balance Advantage Fund. These are funds that he can invest in. He can put in equal amounts in these three funds, and that becomes his automatically rebalancing portfolios that balance between equity and debt. He's only looking at system at 7%, so that should be good enough. He doesn't need to take any more risk than that.
All right, so this is what is your advice for Nagesh and Edelweiss Balance Advantage, HDFC Balance Advantage, ICICI Balance Advantage Fund. And since we don't have all the details, would you also want to explain the tax implications that's involved in having an SWP on your investments?
With the recent tax changes, taking a dividend is treated as income, so you don't want to do that. and that is why we suggest doing systematic withdrawal plans. Just keep in mind that you need to invest for a year so that you don't get hit by an exit load. Most of these schemes have a exit load period for 1 year. So once you've invested for a year, then after that you can withdraw, and then you are. It's like any other redemption. It is categorized as long-term capital gains on which you pay 11.10 plus, which is about 11.22% over and above 1 lakh in gains. So that leeway also you get in terms of that 1 lakh gains. So that is why it's the most tax efficient way currently available to investors, and that is why we suggest that you look at SWP.
All right, so Nagesh, all the best with your strategy on the portfolio. And with that, it's time up on the show as well today. Thank you so much, Gautam, for being on the show and helping our viewers with their financial portfolio queries. And I'm going to leave our viewers with our WhatsApp number and email ID where they can send across their queries, be it about mutual fund, insurance, or any sort of financial plan that you might need for your financial goal. Send across your questions on our WhatsApp number and email ID. Thank you so much for watching. Goodbye.
If you like this video, then like, share and subscribe to ET Now.